What if I told you that every major move in the crypto market since 2014 could have been anticipated by just one key factor: liquidity? Although everyone knows that money moves markets, most investors don't realize just how useful liquidity can be to predict what's coming next. This one indicator helped investors ride a 20,000% rally from 2015 to 2017 and a 2,000% surge from 2019 to 2021. It also warned about the brutal 80% crash in 2018 and the 70% drawdown in 2022. This isn't some magic formula or hindsight cherry picking. It's the same force everyone watches, but very few know how to use it like this. And in this video, I'm going to show you how it's already mapping out the current crypto cycle, not just for the next few months, but all the way through 2028. Because when liquidity expands, investors take more risk and crypto flies. And when it contracts, the risk-on party ends. As Warren Buffett famously once said, "Only when the tide goes out do you see who's been swimming naked." The real question is, how do we know when the tide is coming in and when it's going out? That's where this chart of global money supply comes in. It basically shows the combined global liquidity from 20 major central banks around the world, like the US, China, and Europe. This is important because Bitcoin is a global asset. So we can't just look at US data, since the entire world is a potential buyer of Bitcoin today. Overall, global money supply has been trending higher since 2014, just like Bitcoin. But within that uptrend, there are three distinct periods where global liquidity actually dropped, like in 2014, 2018, and 2022. Now, if we look at what cryptos have done since 2014, it has also been trending higher, but with major declines during the periods when global liquidity was falling. So in 2014, 2018, and 2022. But there's a more detailed way to look at this. Instead of looking at the absolute value, we can track its growth through the year-over-year change in global money supply. When this line rises, global liquidity is expanding. And when it falls, or worse, drops below zero, it means global liquidity is tightening. Now let's put green boxes for when global liquidity was accelerating, and red boxes for when it was falling. If we switch over to the price chart showing the entire crypto market, we can see a clear pattern. Green boxes have generally coincided with upward price movement, and red boxes have coincided with either consolidation phases or price declines. This provides us with clear evidence that global liquidity does in fact affect cryptos significantly, and the data backs this up. Research shows that Bitcoin has an 8.95 times sensitivity to a 10% rise in global liquidity. That means if global liquidity rises by 10%, Bitcoin tends to climb nearly 90%.